How to identify cash flow problems. There are 10 general warning signs that predict cash flow failure, and most owners neglect 7 of them. We can spot cash flow problems usually about 6 months early, and I'm going to walk you through the different signals that we use to identify it. By the end of this video, you're going to know the 7 signals to identify cash flow disaster. We have the privilege of being able to travel around and speak to a variety of groups of people, a lot of people in the contractor space, in the AEC space of architects, engineers, designers, subcontractors, that sort of thing. And we hear a pretty solid, continuous narrative. And when we get past the surface, people will ask, hey, what do you do? And I run this business. Like, all right, so tell me about it. How many employees you have? We've got 18. And they're usually pretty proud until we get to the point where we go, hey, what's your cost of goods percentage? And you can just see crickets. We're not trying to stump them. We're not trying to do anything. We're just asking a basic question. And you can tell that it's uncovered this nervousness and this anxiety of, I don't know how to answer your question, either around cost of goods or revenue or anything related to money. And usually what we'll drop back to in the issue of money is I'm just not that smart. And what I do is I let my CPA, my accountant, my bookkeeper handle that. And what it's doing is setting us up for cash flow problems when we just abdicate everything to these other people. Listen, I'm not against having them do the transactional work to help you out, but it's your responsibility as the owner and the leader of the business to have a general awareness of what's going on and a regular rhythm to ensuring that you understand your cash so you can not only avoid the cash flow problems, but actually create a business that's wildly profitable. And did you know that you can create a profitable business without debt? Absolutely, and we'll talk about that. So the first, the signal that we'll hear or we'll see a lot in a business owner is when they're scrambling around this one question. Where's the money? It's a bad question mark, but you get the point. Where's the money? Where's it going? So my CPA called and congratulated me that I've got a profitable P&L. My balance sheet looks good. All this stuff looks good, but I look at my bank accounts and there's no cash in the accounts. Yeah, I might be doing $150 on net income, but I've got $8,000 in the cash account. I might be doing $5 million on net income, but I've got $182,000 in the cash account. And so when we start hearing owners ask that question, where's the money? That is an alarm and it's a signal to let them know, hey, we may have cash flow problems on the horizon. The second signal actually follows suit, and it usually comes from the bank, and that is when we begin to identify that there is some sort of revolving line of credit. Now, line of credits aren't bad. They're a nice little tool and can help in unique punches and unique timing for a business. But when we identify that there is this revolving line of credit that just continues to cycle and cycle and cycle, what it indicates to us is usually the business is likely not profitable. Because if you took the line of credit away, then profitability would plummet and the expenses would increase and there may not be enough revenue to be able to cover it. That's why we've got to rage over our money. What does that mean? That does not mean we idolize it. It does not mean we get angry at it. What it means is we understand generally what our revenue is, what our associated cost of goods are, COGS, or our COGS, and then by that we reduce cost from revenue and we get gross margin right here, which then tells us what limits we can have on the expenditures to put in the business in order to maintain profitability. But most owners can't walk you through that simple rage model to even give you a ballpark, and many get stumped right here on the associated cost of goods. We'll ask, what are your cost of goods? They'll go, I think 30%. And then we start to look and realize there's 60%. You realize the delta on that? And so it causes people to run to the bank and borrow short-term money that ends up becoming long-term, and it's why you can't sleep all the way through the night, is because you're worried about this perpetual loan that you know you can't pay off because you keep running from the same script. That's a signal to let us know that cash flow problems are on the way. As does the third element, and that is this idea of guessing on price and profit. What do I mean by that? Well, a lot of times when we put our product or service out into the world, we just kind of put a price on it. We look out in the world and see what other people are doing and we kind of put a price around that. And we ask ourselves, hey, is this unit that I just sold to that customer? Is this hour that I just sold to that customer? Is this service package that I just sold to that customer? Is that profitable? Not are we profitable, but is that widget profitable? Is that unit profitable? Most of us have never walked through that. There's actually a simple way to do that. If you'll take your product, whatever a unit of your product is, a unit per customer per month, per transaction, whatever your per is, and you run your P&L through an AI and ask it, hey, what's my profitability per unit? And it'll ask you some questions. And when you do that, you can usually boil it down to start to understand that, but at least start the conversation to be able to figure out what's your profitability and what, based on the profitability, does the price need to be. And many times we've got to elevate our price. In some cases, we can stay the same, or even in some cases lower it, because our expenses, we realize, were too much, and so we can become more competitive. But the bigger issue is making time to think. And so we want to think about our thinking. And in thinking about this, we want to think about price, and we want to think about profit, and we want to stop guessing over this, because guessing leads to cash crunches. And when we're in a cash crunch, then we have no margin for generosity. There's a lot of our businesses and people, regardless of your religious affiliation, your background, your family history, or whatever, we know inherently as human beings that we want to be generous. We want to help other people out. We want to be able to serve other people with our time, our money, our resources, our relationships. A lot of the things that we have access to, we want to be able to deploy those into the service of other people. But when you're in a cash flow crunch, it limits your ability for generosity for two reasons. Number one, it's not just monetary generosity, but it's also time generosity, because you're so exhausted spinning running the same script as to why this thing won't solve itself on a cash flow issue, mainly because we're guessing, or we're still addicted to a line of credit, or we're scrambling to ask, where's the money? We don't have concrete thought and process around this, and so it forces us into a situation we're feeling squeezed and we don't feel the margin for generosity. But listen, I know you want to be generous. That's one of the reasons you got into your business. And so we want to steer our way out of that into generosity, and I'll show you how to do that here in just a minute. If you want to be generous, then you're going to have to stop asking tomorrow's money to pay for yesterday's bills. It is becoming a habit for a lot of people in small business that they're waiting for the next infusion of cash. They're waiting for the next customer deposit so that they can pay bills from last week, last month, or last year. And that slows down our payable cycle. It allows payables to build up, so our back's against the wall. We got to go borrow money, or hard lending money, or whatever it might be. And it also slows down the time and energy we have to go get receivables, or it makes us desperate for receivables, which is even worse because we start violating the terms of both what we've laid out to the customer and also the relational equity that we've got. Many people will say it like this: I'm robbing Peter to pay Paul. Unfortunately, the IRS calls that stealing. And so we want to take off this addictive hat of using tomorrow's money to pay for yesterday's bills. What can help with that is when we gain awareness of the money. And so this is a signal, is when we lose awareness of the money and what it looks like. We're not raging over the money, looking and understanding what general revenue, associated costs, gross margin, expenses are. When we don't do that, then we lose this awareness of that money. And when we lose the awareness, it forces us to lose some of the triggers that we need to do to counteract those things that are going to cause cash flow problems. And so basic awareness, if you want a litmus test of this, just ask yourself this question right now. Can you tell me what your total revenue is for this year? Can you tell me what your associated cost of goods sold percentage is for this year? Can you tell me your gross margin? And can you tell me your percentage of expenses? Just a ballpark, without having to go look at accounting software. If you can't do that, I'm not trying to make you feel bad. What I'm trying to do is call you to action. Call you to realize that as an owner, that's part of your responsibility, is to rage over your numbers and to understand what these numbers are. And the final signal is, if you're surprised by your year-end tax bill, then that's a signal that you are headed for or are in some cash flow problems. And what we want to do is we want to slim you down. We want to lean this thing down and how to do it. So there's a simple framework you can look through. We call it the Slim Pants Framework, where we're going back and we review weekly our schedule, our labor cost, our inventory, our mistakes and warranties. We look back at our pricing, our accounts receivables, accounts payable, our new equipment investment, capital expenditures, our tax liability, and also our servicing of debt. And we begin to just look at that every single week to see where we're at. And it will start to quell some of that anxiety because now we have clarity. And that is one of the things that against cash flow can really bust cash flow in the mouth and help it to come alive, so you can start to use the revenue for what it's needed instead of bowing to the expenses that usually we've taken the E and put it in front of the R. And so it's E-rag instead of rage over our money as to what we're looking to do. So we need to pay attention to these signals that are here. And it's the alarm bell that when we see these things, it notifies us, hey, we're probably either in cash flow problems or we're headed that direction. So I've got an easy solution for you, and then I've got a tool that I think can help you. What we want to do is we want to steer our way out of that scenario when we see these signals. So imagine these are smoke signals. The alarm bell is going off. That's my little alarm light right there. So when that goes off, we want to steer our way out. So the S means subdivide your bank accounts. So instead of operating from 1, 2, or 3 bank accounts in the business, what I want you to do is subdivide your bank accounts, literally go to your bank and get 7, 8, 9, 10 bank accounts. And what we're going to do is when money comes in, instead of dumping it all into 1, 2, or 3 bank accounts where we don't know what money is whose, does it go to cost of goods, does it go to operating expense, does it go to tax, does it go to any of that, we're going to spell it out and say, okay, this 30% goes to cost of goods, this 8% goes to profit, this 7% goes to tax, this 20% goes to operating expense. And so we have these in separate bank accounts, not a spreadsheet, actual bank accounts, because psychologically, once we force-fed it into these separate bank accounts, now we can see how it's actually going to work for us. Now, once we have those subdivided, then what we want to do is we want to T on our steering wheel. We want to track the ABCs. We want to track our ABCs. What is that? Our cash accounts, that's what we just subdivided. Our bookkeeping, that's the accounts receivable and accounts payable that we have the A version of the pants right here. So we want to see what we're owed and what we owe. And then the C's are the customer metrics. Whatever you do to track customer metrics for lead pipelines. So if you're looking for website hits or mailers that go out in responses to that or one-on-one appointments, whatever it is you track to see what customer development looks like. And then what we're going to do thirdly is we're going to review this weekly. We're going to take that dashboard that tracks our weekly bank accounts, weekly receivables and payables, weekly customer metrics. We're going to review it every single week. Subdivide the accounts, set up a dashboard, track it every single week. And when we do that, we start to gain the clarity and understanding how we're raging over our money and we're setting up walls against cash flow crisis. You're not going to do this alone. If you go down in the description link below, I've got a link down there called solvecashflow.com. This is a powerful handbook that we have built just for you to sit down with you, your team, whoever it might be, and start to methodically build out this thing that's going to steer you out of cash flow chaos or set up a bulwark, a wall against impending cash flow chaos. Why? It's because we don't want you to suffer from cash flow chaos. We want you to be liberated from that chaos so you can make time for the things that matter most.